All right, thank you for being here tonight. Covering chapter 9, the government-related loans and then other finance options. Chapter 9 talks about, so we just covered chapter 8 last week, talking a little bit about finance, how the finance world works, which you may have never heard of or seen before, where there's the primary market, the secondary market, how loans are bought and sold into the secondary market, how investors play in and where their money goes. And then as a borrower yourself or myself, right, when we're looking for a loan, where we go for that, right, a typical bank or credit union. So chapter 9 is a little bit more kind of behind the scenes as well, in a sense that even though a loan might be government backed, you're not going to the government and asking the government for a loan, right? And so let me go ahead and share screen. I'll talk about some of the options that come up in chapter 9. I'll go a little bit, chapter 9 is a little bit shorter of a chapter as far as what I feel is like important for you to remember. I'm looking at chapter 9, thinking about what you're going to be needing to know for the real estate exam. So I'm giving you a little bit of practical knowledge with chapter 9, but also I didn't want to dive too deep to make you feel like you have to start memorizing some of this stuff for the sake of the real estate test. So first off, we're going to talk about FHA. So FHA is an amazing program that exists. FHA, the whole point is that it's government backed. So the idea here, the whole goal of FHA is to get people into homes. And so because of that goal, there are programs that are FHA that you won't be able to get otherwise. So you can use an FHA loan when you're buying your home to live in yourself. And it's possible for you to buy a home, live in it, and then maybe go buy a different home later on to live in it as well, and maybe still use FHA, but there are some pros and cons to that. So your book might not go into so much detail, but I want to give you some real life picture of what FHA looks like. The fact that FHA is government backed, meaning that it's insured by the government, kinda. So you might go to Wells Fargo, Bank of America, Citibank, and you say, I want an FHA loan. And they say, here, we have this program. Let's put in your application. Now, FHA means, again, the government is backing it up, which gives the bank a little bit of flexibility. Also, because you're the one benefiting from that program, the FHA program, you, the borrower, are going to be paying a fee every month to actually pay for that insurance, if that makes sense. This insurance is called MIP or PMI, whatever order those initials are. It's mortgage insurance. Mortgage insurance premium is the term that's typically used for this. So this is on top of your principal that you're paying back, on top of the interest rate that you're paying every month, on top of your taxes and insurance that you're going to be paying, you're going to be paying an additional fee that insures this loan. Because of that extra cost of the loan, they offset that. So FHA is usually going to have a lower interest rate than you might be able to get in a commercial loan. It has lower interest. And again, because it's government backed and you're paying insurance for it, the bank can be a little bit more flexible with those rates. Usually though, it's not the bank necessarily that's making up the rates. It's kind of a standard rate that's used for FHA. So you'll have a lower interest rate potentially, but again, you have that extra cost. So I'm going to do like a pro and con, okay? So over here, you're going to have MIP. And just to give you an idea, if you were to borrow 700 grand, round numbers, if you were to borrow 700 grand in your loan, your mortgage insurance premium is going to be about $400 a month. This is round numbers, but I'm just giving you an idea. So your loan amount, 700,000, you're gonna be paying out about $400 a month on top of, again, principal, interest, taxes, and insurance, PITI. Also, hey, if you're in an HOA, like you're buying in Irvine or maybe areas of Mission Viejo or Lake Forest, there's an HOA, or you're in a condo, that's added on top. That's even more money out of pocket. So one of the benefits, lower interest. One of the biggest benefits of FHA is that you can borrow up to 96 0.5% loan to value, which means that you, this new homeowner, right, you have to put down only 3.5% down. That's a really high leverage loan. Most banks don't do this because of the risk, right? If you can't make your payment, you walk away, you're not really out that much money comparatively. And so the bank sees it as higher risk. It is higher risk. And again, that's why you have to pay that mortgage insurance premium. Now, in the past, that mortgage insurance premium went away at some point. But today, if you get a new FHA loan, that mortgage insurance premium never goes away until you pay off that loan. So at some point, when you're able to refinance, maybe when your LTV gets to like 80% and you have 20% equity, you refinance without having to pay that MIP, and hopefully your payment can go down at that point. One of the benefits about FHA, this down payment, this 3.5 down payment can be a gift. Now, in a normal loan, banks do not like that. A bank doesn't want to see you borrowing money to buy a house, because if you don't have the money, how are you going to make payments, right? So the idea here with FHA is that, again, the goal of getting people into properties, lower interest rate, lower down payment, you can even have a lower credit score. A typical bank, your A paper, your kind of higher, lower rates possible with your higher credit score is going to be around 720. FHA is going to be able to get you down to 680. And then maybe they could even give you a loan closer to 600, but the interest rate might go up a little. So the idea, again, the goal of FHA is to getting people into homes. The government knows when people own homes and live in the homes that they own, not just renting, it's better for the economy, it's better for communities, it's better all the way around. So here are some of the big benefits of FHA: low down payment, lower interest rates, lower credit scores that they take. Again, one of the big downsides is that MIP, that mortgage insurance that you're gonna have to pay for the life of that loan until you refinance or pay it off. All right, so that's a real quick overview of FHA. Again, this $400 you're paying out of pocket to insure the bank. So the last recession we saw, and maybe we'll see it again, we don't know yet, but the last recession we saw in 2007, 8, 9, there was a whole bunch of homes hitting foreclosure in 2010, 11, right? The Great Recession, they called it. And that one of the big parts of that, if you think about those banks losing the money when they foreclose, if those loans would have been FHA, the bank would actually have been insured for the loss. But most loans that were being lost were not FHA. And in large part in California, because the home values are so high, the number of FHA loans are actually pretty low because of the limits of FHA. So you can look up online. Yeah, actually, you know what? Let's take a quick break at this. Let's just see. Let me get off my iPad here. We'll share a screen. There's a talk about loan information here in just a minute. FHA limits, and it's by county, so Orange County. Not sharing. More sec. There we go. So here's FHA limits in Orange County. You can see the websites there. What's really cool and what people don't realize about FHA is you can actually use an FHA loan to buy up to 4 units. So remember, FHA, the goal is for you to live in a property. But if your goal is to invest long-term, instead of you buying a house now and then trying to invest and buy an apartment building later on, a 4-unit building, your down payment for that 4-unit in the future is going to be at least 25% down, which, you know, $1 million plus property, you're talking about hundreds of thousands of dollars of cash that you would have to have in the bank. But you can actually use FHA loans to buy a 4-unit. You would actually be living in one of the units, right? It's supposed to be owner occupied for FHA, but you could rent out the other 3. Something pretty cool. If you don't mind living in a unit and then renting out to other people that live in the building, this could be a great plan of attack for you. What's cool about the 1 to 4 units too is that FHA, the government knows, this program knows that those other 3 units, you're going to rent them out. What's cool about the FHA loan on a 4-unit purchase is that they actually count like 75% of the income from those 3 units towards your income to help you qualify for the purchase. It's pretty sweet. So if you think about it that way, it's actually easier to purchase a 4-unit income-wise with your own qualifications, right? Your own check coming into your bank account. It's actually easier to purchase a 4-unit because you have added income to account for to qualify for the loan. Pretty interesting. Most people, of course, don't do it, but I have helped people, and I've been involved in transactions with 4 units where an FHA loan was used, and it works. Here are the loan limits. You'll see FHA for Orange County, 822. So this has gone up over the years. For a long time, back 2000, I think 8 or 9, it was like half of this amount. It was like 450 or something. So now here in 2021, we're seeing a range at 822,000 for a 1-unit home. And then you see up to 4 units there, the price bumps up. At 2 units, it's more. At 3 units, it's more. And then we see here at 4 units, it's at 1.58 million. So, maybe that could buy you a triplex or a 4-unit in some cities in Orange County, or maybe LA. Oh no, LA County has different amounts, but it's probably the same. Orange and LA are about the same usually. Cool, so that's a little bit of information on FHA. Really strong program, really helpful to help people. I've used the FHA program myself when purchasing my second home. I don't remember if I used it for my first home or not. So let me get back to my notes here. So again, just to recap, excuse me, FHA means government backed, means that the bank is actually insured. The bank is insured, but the borrower is the one that's actually paying for that premium, the mortgage insurance premium. And we saw the limits. That's one of the other downsides. There are limits. But 800 grand, there's some nice areas of Orange County that you can get homes for still at 850. So that's a loan amount of 850. So if you're coming in with 3.5% down, I'm not that quick with my math, but say you have 40, 50 grand, right? That's close to a $900,000 purchase. You can get a house for that in Orange County. There's one other thing, or another type of loan that's detailed in this chapter. Just to give a real quick overview, there's Veterans Affairs, right? So there's a federal program that is created to help veterans. And then your book goes into crazy detail about what constitutes a veteran for that program. Some of them are super specific, like certain service dates, wartime service versus not wartime. The last 20 years basically has been wartime, right? So what we're seeing today is totally different than what has happened historically for veterans coming out of service. So here's this federal program called the VA. And then we have something in California called Govt. So some of the cool, and this is also specifically for veterans, but the qualifications might be different, right? So what the government requires in the VA program might be different than what California, the state, requires. All that to say is that some of these programs are really great. I've seen some vet loans that require like no down payment, right? No down payment. But here's what I want to focus on for the sake of you, for this class, prepping for the real estate exam in the real world. This is a very small percentage of loans that come through our vet loans. If a veteran qualifies for them, they are usually really great loans. There is red tape. They can be slow. It's the government that's issuing these loans or that's backing these loans as well. But they can be really great programs. For the sake of you in where we're at right now, I don't want you to memorize all that stuff about what qualifies a veteran for VA versus Govt and what service years and all that stuff. Don't memorize that stuff. But please recognize when we're talking about VA, again, stands for Veteran Affairs. Or when you hear Govt, we're talking about veterans loans. And so obviously these are for military veterans, for people that have served our country in the military. And that's pretty much, I don't want to say it's that easy, but in a nutshell, you're looking at these loans specializing for veterans. And that's all I want you to focus on right now. The qualifications are super specific in these loans. All right. Up next, the chapter also addresses creative loans. So I want to talk and mention about creative loans in the sense of this, not typical, right? Some people use the word creative and they think like illegal, and that's not what we're talking about. All we're talking about here is something outside of the norm, which means the norm is buyer goes to bank, application process, bank gives the loan, you purchase the property. One of the different creative ways you can purchase property is called a seller carryback. Pros and cons though. So I just want to do a little bit of overview of a couple different creative purchase options. I have seen one, two, if not all four of these, 3 out of the 4 that I'm going to talk about right now. The first one is called a seller carryback. What this means is that the seller is becoming the bank. And that sounds weird, right? But let's just say the seller sells at $1 million. I'm just making up numbers. So you're buying a house for $1 million and you're coming in with 200 grand. That means you need to get a loan of $800,000, right? Now, typically you would go to Bank of America or Wells Fargo or Citibank or FHA even for that matter. You probably wouldn't want to do FHA for this loan though, because you're going to have to pay that MIP, right? And so you're going to be putting down $200,000 and paying a premium for the insurance. You probably wouldn't do that. Usually at this loan to value, 80% loan, right? Here's our 80% loan to value. You do not have MIP. So you'll see a lot of programs out there. If you hear commercials or you look up on websites and banks, typically they're looking at like an 80% loan, 20% down program. If you're hearing a crazy rate, like come refinance today for 1.9%, and you're like, what? That's low. Well, maybe it's not a 30-year loan. Maybe it's a 15-year loan. And to get that 1.9, you have to have an 800 credit score. And by the way, not 80% loan to value. We're only going to lend you 50% loan to value. And right now, there's all these other stipulations that come into play. And you have to pay a point up front to get the 1.9%. So there's always, when you hear crazy commercials or crazy rates, there's usually always some sort of stipulation. Doesn't make it illegal. They're just marketing a product, but they're not giving you the full picture when they tell you 1.9%. That sounds amazing. They're not showing you all the stuff that has to happen for you to get that 1.9. So our seller carryback, we're looking at this loan of $800,000. Instead of you going to Bank of America, Citibank, Wells Fargo, credit union, wherever else, the seller carryback means that the seller is not going to collect $800,000. They're going to take your 200 and they're going to give you a note for 800. Now you look at this, you go, why in the world would a seller do that? Well, maybe that seller doesn't have to go find another house. Maybe that seller would rather, instead of taking 800 grand and getting taxed on $800,000, maybe they would rather get taxed on, and I'm not a tax advisor or a CPA or anything, but here's some of the ideas, right? I'm actually going to get taxed on maybe the money that I collect, which isn't 800, it's your, $4,000 a month payment. So there's a way to earn interest on your money in this scenario, right? But look at what this requires. The seller carryback requires that the seller have equity in the house. If the seller is paying off a loan of 200 grand, maybe this could work. If the seller has a $400,000 loan, this might not work, right? So the seller carryback requires that seller to have equity, which isn't always the case, especially in Southern California. I have seen it. Maybe the seller carries back a smaller amount, or something like that. Another type of creative, again, quote unquote, creative loan situation is something called a land contract. And I don't want to spend too much time on this, but your book does say these words, and so I wanted to at least bring it up. The land contract, think of the word contract. So the idea of a land contract, instead of you buying the property outright, in essence, there's a contract for you to purchase that property. And I want to stop it there. Just enough for you to realize that this is not a typical loan. This is a way to purchase property. Again, considered creative, not typical. Most likely you'll never see it. But focusing on that word contract. The idea is that you're using a contract to purchase property as opposed to you using dollars, really. The flip of this, and this one I'll go a little bit more into. Again, typically I've seen one or two of these in 9 years and hundreds of transactions, okay? The subject to loan looks a little bit like this situation that I just mentioned. Let's say the seller sells back our $1 million home. $1 million home. The seller, let's just say the seller owes. So these are different numbers, but this is the situation that this happens to me with. I have a seller, they're selling their property. They say, I want to get $1 million, but it's higher than market and nobody wants to pay $1 million. In addition, in that market at that time, at that location, with that type of property, right, all these different variables, nobody was willing to spend $1 million and nobody had the down payment that was required to purchase this property. How do I know that? We had no offers over months, okay? So I get a buyer that says, hey, Rick, I'm interested to buy this $1 million property subject to the existing loan. So this existing loan, this $800,000 loan that the seller owes the money on, right? We're not going to pay it off. The buyer comes in, takes over payments on that loan, and in essence was able to buy the property, quote unquote, at $1 million without putting $200,000 down, right? Because there was no actual transaction to pay off the old loan. Now this gets really creative, and some of you are looking at me and you're going, what is he talking about? Don't get too hung up here. But the word subject to, I'm going to actually change my arrow here. The word subject to means that the purchase is subject to this dollar amount, this loan that the seller owes the money on. Now, here's the downside to this. We're talking about no new loan from a buyer. Here's the downside, and this is actually what happened. The buyer stopped making payments during the recession, and the bank foreclosed on the property. So the buyer that walked in with very, very little down payment, the seller walked away with, I think it was maybe close to 100 grand. So the seller was happy. The buyer lost the property because the bank foreclosed, and it was the seller's credit that got beat up with the 30-day late, 60-day late, 90-day late, 120-day late foreclosure. The old seller that moved away with his 100 grand was the one that really affected his credit. But you know what? He didn't care. He needed the money. He got his 100 grand up front. And even though his credit got messed up, he was set up. So the buyer, if the buyer could have continued to making the payments, the buyer really could have went out, right, to get a property with so little money out of pocket, an investment property. It was like a 7 or 8 unit building. Hopefully that didn't go too deep for you. When you see subject to, what you're saying in your brain is subject to the existing loan. And here's the other ticket to this. The seller, even though the property changes hands, the seller is still liable, right? It was my seller whose credit got messed up. That's the risk of the subject to purchase. So normally if a seller learns about all this and they go, wait, my credit's still affected here, they're like, sorry, I'm not interested. Not typical, again, creative, not a typical way to purchase property, but possible, legal. The last one we'll mention is called the sale leaseback. This almost always happens with commercial properties, but it could technically happen with residential, where the seller of the building sells the property. You're the owner, you buy the property, you own the dirt, you own the building. But in that contract and in that purchase, it's stipulated that the current tenant, the old owner, continues to lease the property. And so let me give you a real life example. My brother-in-law has a business. My brother-in-law years and years ago bought a building for his business to run in, offices and a warehouse. They work in the building, all of their equipment is in the building, all the employees work out of the building. He wants to take a chunk of money just for his personal use for the business. So he sells the property, makes hundreds of thousands of dollars on the sale, but his business still needs a place to operate. So in that transaction, he sold the property, made a couple $100,000, and then he makes lease rent payments to the new owner, and his business never moves. This is the example of a sale leaseback. Again, most typically with some sort of commercial or office type functions. Although again, it could happen with residential, it's not typical at all. So here's an example again of some creative ways to purchase property, both the seller carryback, where you're using the seller's equity instead of bringing in new money from a bank. A land contract, which again, I'll focus in on that word contract. So you're purchasing the property under contract and not with the transfer of money. Okay, and again, I don't want to go too deep on that because it's kind of confusing. As we saw with the subject to, right, not typical, but when we hear subject to, we're thinking subject to the existing loan, right? So the seller remains liable for that money. And then lastly, the sale leaseback, where you're selling the property, but you're leasing back the square footage inside to continue using that space, again, most typically with a business. So kind of a really quick overview of chapter 9, but hopefully this gives you a little bit of clarity, especially when talking about FHA programs, which are typical, which are normal. It's just a normal bank, but because of this government-backed situation, because as a borrower, you're paying for this insurance, this mortgage insurance, you're able to benefit from some of these items in the program. Lower interest rate, lower down payment, lower credit, and you can still purchase property. We just saw the limits up to $850. Pretty interesting. Some of you also might be working on the project for this week, or the exercise that I have slated for this week, which is finding a loan. And so the idea here, I'm going to go ahead and oh, and I see your question here, Denise. Thank you. VA versus FHA. I'll address that in just a moment. Let me go ahead and share screen on a Internet Explorer here. Now, again, what I told you all in that exercise was the idea of not entering your email to get information. So when you look up loans, here, let me just do it real quick. Watch this. New home loan. Every one of these links is a marketing thing, right? Any one of these that I click on is going to be asking for my information. You're going to be getting phone calls from these people for years because they're going to say, hey, you may be interested in a real estate loan. Don't do this. This is what I'm telling you in the exercise. What I'm telling you exercise is go to a specific bank. Here's schools first. I mentioned using credit unions. Credit unions are really good for publishing their information, publishing their rates. So here's schools first, credit union. Use any credit union you want, any bank you want, whatever. But notice here on the right, it's published. mortgage, 30-year. Look at that. And when you click on the link, more about 30-year fixed mortgage, here you're going to start seeing, hey, look at this. They actually have a program. If you're a member of this credit union, they have a program that looks similar to FHA. I love credit unions, by the way. I've used commercial banks over the years, especially in my younger years, college and up. Wells Fargo, Bank of America, you know, the big name banks. Credit unions are amazing because they don't have stockholders. You could buy stock in Bank of America. So Bank of America might be making decisions for their stock shareholders, not necessarily their customers, right? In a credit union, you are the customer. You are, in essence, the owner. You are a part owner of this as being a member of a credit union. So the decisions that are made for credit unions are usually made to benefit their members. I don't work for the bank. I'm not getting a commission by the bank, but my experience has been that their rates are usually really competitive. Customer service is usually unmatched. I'm sure there's bad ones out there, but this credit union is amazing. You can see right off the bat, here's a refinance rate. Here's a purchase rate. So when you're talking about looking up information on rates, here you go. You'll notice some of these rates. Oh, wow, that looks amazing, 2.875. Well, we're talking about a refinance. You already own the home, right? We're also talking about a 30-year fixed, and look at the loan amounts. So when you're answering some of those questions in the exercise, like what are the other terms for this loan? Here's a limitation, right? Here's another term. To get that 2.875, you're going to have to pay up front 1 point, which is 1% of the loan, right? So if you're borrowing 700 grand, this is $7,000 you're going to have to pay just to get this rate. Now, is it worth it? That's up to you. No points, you're at this rate, and look at this rate, and they're actually paying you a point to help you cover some of your fees. This is all a refinance. Now in Orange County, if you're looking to refinance and maybe your loan is higher than 548, then you're going to have to look at this jumbo loan column. Here's our purchase rates. Again, just the idea that this information is available to you. You also might see additional disclosures that you can read about that might stipulate credit scores, debt to income, how much debt do you have, like credit card debt, student loans, and all that stuff, usually relating to the payment that you're required to pay. That debt that you have, how much your payments compared to your income. Usually with all of your debt payments, credit cards, car payments, student loan payments, all that stuff, all of those payment amounts, plus your new mortgage amount, they usually they don't want you over 50% is like the most aggressive usually that I've seen. So all your payments amounts plus your new property payment amounts should be under 50% of your actual gross income. Some banks might even use net income. So just to kind of give you an idea of when you see a rate, that doesn't just mean you call up and you get that rate, right? We're talking about a lot of details that come into play here. The loan amounts, whether it's a 30-year fixed versus we saw up here a 15-year fixed, a 10-year fixed. Let's just see the difference at a 15-year fixed, and we're going to refinance. Look at the difference. It's almost a whole percentage point less. That rate looks amazing, right? But here's all the other details. And because it's over 15 years, your actual payment amount is going to be more per month, right? Because you're paying it off quicker, even though the rate's less. Anyhow, so that's a couple things you can look at regarding I forgot how I termed it in the exercise, the limitations of the loan, the requirements of the loan. Yep. All right, so thanks again for being here, hearing a little bit about government-backed loans and creative loans. And I'm going to go ahead and stop recording.
I have a question.
Yeah.